The value of a stock does not depend on 1 year's profits or losses. DCFs go many years out. And therefore, the question is, are the markets recognizing this correctly when there has been a bounce in the markets at large? The talking point today, though, is about financials. And whether financials, which have had a bit of a roller coaster ride thus far, but are largely under check compared to some of the other peers, can ride out this storm, and are the valuations where one can make fresh investments considering the fact that the DCFs go so many years out. Marcellus investment managers, I believe that these stocks can ride the storm. I'll try and play the devil's advocate today in this conversation and try and question our guest, Pramod Gubbi, who's head of sales at Marcellus, on his optimism with regards to the financial space at large and the specific high-quality financials which they believe can ride out the storm. Pramod, so good having you. Thanks much for taking the time out and speaking to us on the talking point at Bloomberg Quint. Hope all is safe.
Yep, all well, touchwood. Pleasure to be here again. Thank you.
Thank you so much. Thank you, Pramod. So what's the pet theory, Pramod? Why should one trust these companies in a sector which is grappling in the dark and walking on a minefield?
Yeah, I mean, I don't think it's any different in financials compared to any sector. Ultimately, we want to buy businesses which have very, very long shelf lives. And that sustainability is what we tend to assess across industries, more so in financials, because the benefit of survival is far more disproportionately large in financials because of the very nature of the financials companies, whether it's an NBFC or a bank. By its very definition, it's a leveraged balance sheet, right? In more ways than one, financials are a leverage play on the economy because credit to GDP ratio is north of 1. Therefore, obviously, in an upward cycle, credit growth is faster. In a recessionary period, several of their borrowers go bust. So obviously, the drag is not just in terms of growth, but also asset quality means that the downside hit is much bigger than what the economy would take. Plus the fact that the balance sheet itself is leveraged. Remember, the capital adequacy ratios could be anywhere between 10 and 20%. And therefore, you are looking at anywhere between 5 and 10 times leverage. Whatever impact, whether it's positive or negative, tends to be amplified for this sector. So to that extent, the need to look at the survival capability of these companies is that much more accentuated in the financial sector. So I don't think financials as a whole is something that we are positive on. You will see a lot more mortalities in these sector compared to other sectors. And that means all the more reason, if you can find those 1, 2, 3 strong balance sheet companies which have the highest survival instincts, then on the other side of the crisis, the benefits will be disproportionately large because you'll tend to take a large part of the recovery to yourself, but having to compete with fewer and fewer places. So that's what excites us about at least the financials that we have in our portfolio.
Okay, just a follow-up, Pramod. I mean, excuse me if I sounded like I'm questioning investing in financials completely. The question is more about the tactical nature of when to maybe invest in as well. But just a follow-up question to, or rather a point that even rating agencies are making, right? Fitch statement yesterday when the medium-term GDP growth outlook was a question. They mentioned that there are renewed asset quality challenges in banks and liquidity issues in NBFC. Is there not a clear and present danger for the next 6 months? And therefore, tactically, is it possible that these financials may actually not be attractively priced currently?
Well, I mean, there's no doubt we're going through extreme challenges as far as the real economy is concerned. And like I said, financials are a leverage play on the economy. And therefore, across the financial sector, you will see an increase in asset quality challenges. NPAs will rise for pretty much every single bank or NBFC, but it won't rise evenly. There will be a significant difference between the NPA increases for some banks and NBFC versus the rest of the sector. The question is, how do you decide which banks and NBFCs will see a relatively less increase in NPAs and therefore have the better chance of surviving this crisis? So which is where prudence comes into play. I mean, there is no, in fact, there are negative points for bravery in this sector.
Yeah.
The better financials companies are always the ones that are able to resist the temptation of greed, because when the economy is going great, there will be plenty of credit demand. There will be a lot of new competitors, a lot of new NBFCs and banks which will spring up. If during that time, if you keep your heads cool and keep your underwriting standards fairly high, even if it means that you compromise on growth, you grow slower than the rest of the industry for a couple of years, during these times you'll reap the benefits of that, because your balance sheet will take much lesser hit than the rest of the sector, and therefore your ability to survive this crisis will be better. So at the end of the day, prudence is the name of the game when it comes to financials. If you're sensible about taking risk at different points in the economic cycle, that can ensure that your ability to survive crises like this. I mean, remember, nobody will go unscathed in terms of having no NPA increases. Even the best of banks and NBFCs will go through that. But at least you'll be significantly better. And alongside that, if you've kept your balance sheet intact by consistently delivering high ROEs without having to dilute capital at low valuations, that adds another layer of your ability to survive the crisis. Low NPAs, strong balance sheet. And the third aspect I'd like to focus on is, what is your source of funds? At the end of the day, money is the raw material for these banks and NBFCs. The lower your input cost, the lower your cost of money through low cost deposits, allows you to generate a decent ROE and decent margin without having to take higher risk. If you are dependent on high cost wholesale deposits, then obviously for you to generate the same margin, you'll have to lend at a higher rate. And when you're going to a higher yield trajectory on the asset side, you're obviously lending to borrowers who have been shunned by other banks and NBFCs. So naturally, you're sort of shooting yourself in the foot by taking on higher risk and are likely to be vulnerable at times like this. So if on the other hand, you've built a liability franchise with very low cost deposits, current accounts and savings accounts for a bank and NBFC, which are both granular and you don't pay over the odds, you don't necessarily have to go after the high risk borrower seeking higher yields. You can lend to the safest borrower with very sensible yields and still make a healthy ROE. So all three come into question: prudence in terms of lending criteria, a strong balance sheet, and low cost deposits.
Okay, let me ask a couple of follow-ups there. There is a chart that I'm borrowing from a Bernstein report, which is, of course, on Bajaj Finance. But I think in an Exhibit 12 that they've put out, they've said that credit costs for almost all of the institutions, regardless of the quality or the pecking order in terms of quality, will move up. Is that high near-term risk?
Yeah, absolutely. I mean, like I said, I don't think we need to second guess. Just standing near my window and looking out the window, I can write this report that the economy is suffering, and therefore NPAs will go up. The question is, to what extent, and will it be across the board, and will the balance sheets of these businesses be able to sustain these sort of NPA increases? Because eventually, I hope that is the case, because in this case we need to hope, because not everybody is seen what's at the end of this crisis. But if our view is that this crisis is never ending, I think we have bigger challenges in life other than looking at stocks and our savings. But assuming that this crisis will end at some stage, there will be recovery in the economy. There will be recovery in credit growth. And if you are one of the few to be standing there to take advantage of that recovery in credit growth, this can be supremely beneficial.
Okay. So Pramod, let me ask this from a perspective of somebody who's watching the show right now and wondering. So yes, nobody will probably argue that, let's say, the HDFC banks or a Kotak Bank or a Bajaj Finance, etc., or some of the others too. I mean, I'm not getting into what I think is great, will survive. The question is, would there be larger problems, and should, as an investor, you take cognizance of that? Now, in your blog, and it's a wonderfully written blog, by the way, you made some comparisons of what some of these consistent compounders in the financial space do in the past cycles, and can that be taken as a template? My question is, and I'm trying to play devil's advocate on almost all the points that you put out in the blog. My question is, isn't the past cycle drastically different or profoundly different compared to this time, because the personal loans are 5x the last cycle peak, credit card loans are 3x or 4x the last cycle peak. So isn't the gravity of the problem slightly higher or substantially higher than what it was in the past cycles? And therefore, should comparisons with past cycles be pertinent?
No, indeed, every cycle is different. There are various variables which differ from cycle to cycle. Much like the credit penetration, particularly consumer credit, historically Indians have been significantly lower in terms of credit penetration. This time we've seen an increase in this cycle. But you should also see the other change, which has benefited lenders: data availability, and therefore the ability to appraise risk for borrowers, whether it's the cibil scores. Now it's not just cibil, there's several other sources of data that are available at the behest of these companies to be able to take advantage of being able to use data to assess credit risk, and therefore the lower chances of being able to pick the wrong borrowers. So that's a significant change from the previous cycle to another. If you were to take an optimistic view on the borrower's credit quality, I think that this is a big change. Now, obviously, different lenders, different banks, and different NBFCs have used this data to their advantage differently, and therefore, from a better position, having built competitive advantages around technology, around data analytics, to be able to improve their credit selection, they will be able to fare better, even in this scenario where a higher credit is affecting everybody, whether it's consumers, SMEs, large corporates. Everybody is getting affected by the current economic recession, and therefore NPAs will rise across the board. But if you have used these tools, if you have used this data analytics to your advantage to have picked the better borrowers in the first place, I think this is a big change compared to the previous cycle. I don't think whether it's in 99 or in 2008, banks and NBFCs had access to this amount of data to be able to differentiate between a good borrower and a bad borrower. So I would agree with you. Credit penetration is much higher. The scale of the problem is much bigger. But at the same time, for the better quality lenders who've built competitive advantages around these, I think this will separate the sort of wood from the trees.
Interesting. You don't. The one other aspect, and I wonder if it worries you at all, and what are your thoughts there? Again, there was some data that was thrown out which said that the credit card loans, for example, as of December 2019, were not being handed out to the prime plus. I mean, A category borrowers, but because that was exhausted, it came down a bit to the B or C plus or C. Is there a worry that that could turn out to be a problem? Or, as one of the guests earlier this week told me, that millennials and everybody else who are taking these loans are very conscious about their credit scores, and they wouldn't let it get hurt. I mean, which side of the argument are you on? Or is there a separate argument that you have, and why?
No, I think it's partly right. Remember, when it comes to repayment of a loan, there are two aspects. One is the ability to repay, and the other is the willingness to repay, right? So the question is, given the current economic recession, even those who were willing to repay, their ability to repay might get affected, either because they're out of jobs, either because, you talked about millennials. A lot of millennials might be spending their future incomes through credit. In that case, if they're out of a job, I don't think their willingness of keeping their credit scores high matters at all. So they will default, which is why I'm saying I don't deny the previous chart you showed that there will be an increase in NPAs. There will be asset quality issues across the board. But the question is, how have you gone about choosing your borrower? Have you first used any tools like data and analytics on the one hand, and general prudence? Like I started by saying, for a lender, conservatism is a source of competitive advantage. There are no points for being aggressive, especially when the cycle is upward trending. It's easy for a lot of NBFCs and banks to demonstrate very strong loan book growth. But if in that process, if you have let down your standards of lending, then it'll come back to haunt you. So the bottom line is, across the board, there will be increase in NPAs, but some will see relatively less increase in NPAs compared to others. I think we are already seeing, based on the data coming out about how many borrowers are opting for moratorium across different lenders, you can see that spectrum playing out. You have, on the one hand, there have been NBFCs with more than 90% of their borrowers opting for moratorium, and there are NBFCs and banks with less than 10% of their borrowers opting for moratorium. That itself reflects the quality of the asset book.
So is the market recognizing this duly already, and is it showing in the valuations, or do you believe that one should look at past valuations and try and see that if indeed a high quality financial name is available substantially lower than that mean valuation benchmark, then it's a good investment? I mean, the argument might hold true to an extent for an HDFC Bank, for example, because that would be lower than the mean, and it'll be substantially lower for a Bajaj Finance, for example, which I also presume is a part of your portfolio. But I mean, there is a distinction that the market is trying to make out there.
Yeah, I think in some ways, I think this crisis might even justify a higher than historic valuation. And the reason I say that is the sort of fatalities we're going to see in the financial sector. So that every crisis brings a big bout of consolidation, right? And the consolidation means that whilst the market opportunity remains the same, you have fewer competitors to compete with. The ones that will survive tend to emerge out on the other side of the crisis with a larger market share, and therefore a larger share of the future opportunity. And that should in some ways justify a higher than historic level of valuation. Having said that, we are not basing our investments based on any increase in price to book or price to earnings multiples. We reckon that the stocks that we're buying today are trading at prices significantly lower than what we believe is our most conservative estimate of their intrinsic value. As long as that is the case, we intend to generate returns from these investments simply by the growth prospects of these stocks, and not really any sort of multiple expansion. If the multiple expansion comes through, that's a bonus. But at current valuations on an absolute basis, we believe there's significant value in the companies that we're investing in.
Could the market promote your wisdom, because you understand some of the market cycles as so well, if indeed over the course of the next 2 quarters, the asset quality worsens, there are one-offs, but still there are large one-offs that come in even from a high quality lender, could these valuations or could these prices, for example, go off a little bit? Because let's admit, I mean, an HDFC Bank is no longer at 800 or 750 that it was when we hit 7,700, or a BAF is not at 1850, the recent lows that it did at 2,500, or a Kotak Bank or some of the other high quality names. They are no longer at those trough valuations. Yeah. Could there be a chance that they could tactically become more attractive because of the news flow in the next 6 months?
Absolutely. I think there's definitely a chance. Is there a certainty that they will come off? I don't know. But I think that's the toughest part of our jobs. And we, for one, have sort of accepted that we don't have really great capability in terms of timing our entry and exit from these stocks, and also in terms of predicting short-term stock prices. Let alone at these times where the number of variables outside our control are so many, that if we were to tell you that the stock is going to be lower tomorrow or a week from now or 6 months from now, we'll either be lying to ourselves or lying to you. Having said that, I think given the sort of variables we're looking at, potentially a second wave coming through on the health scare, potentially a further recessionary trend, all sorts of factors can bring down HDFC Bank back to 800 rupees. I don't deny that at all. But having said that, my only concern is at the current price. Is the current price trading at a significant discount to our estimate of the intrinsic value? That's the only thing I can do for my clients. Anything else will border on the realms of speculation. And I don't think I should charge fees for speculating on our clients' money. So we'll stick to absolute valuations. We see value in these companies. If it comes down further, we'll buy more. We are open to the possibility. We're certainly not denying that we've seen the worst. But yeah, I mean, this is as good a time as it can get.
Okay. Just a follow-up, Pramod. Are you making a distinction? Let's first talk about the lending financials. Are you making a distinction between high-quality banks and high-quality NBFCs? Because until 2019, some of the high-quality NBFCs were sought after much more than high-quality banks as well, at least in terms of valuations. Now the reverse seems to be playing out. Are you making a distinction, historical valuations compared to now and then between the two?
No, I think naturally, again, if you were to say financials were a leverage play between banks and NBFCs, the NBFCs tend to be even more leveraged in some ways,
Yeah.
partly because of their lack of ability to rely on very sticky, granular retail deposits, right? They can't raise a current account or a savings account. They naturally tend to have higher cost of funds, and therefore they tend to play in areas where they can generate a healthy ROE even with that higher cost of funds, naturally moving towards higher yield assets, or in places where the bank cannot operate. So to that extent, NBFCs naturally will be sought after in an upward cycle, and they also tend to take equal beating in the downward cycle. For us, that distinction doesn't matter. At the end of the day, we look at the same three factors: the strength of the balance sheet, the strength of the deposit base, and the prudence of the management team when it comes to their lending standards across banks and NBFCs. Banks obviously give us a lot more comfort. In some ways, the only NBFC we hold in our flagship strategy, the consistent compounders, and also the NBFC we hold in the small cap strategy, Little Champs, both have very similar characteristics to that of a bank when it comes to the other side of the balance sheet. Their capital adequacy ratios are perhaps higher than most banks in the country, with north of 25% capital adequacy. Their asset liability profiles are positive, where the duration of their assets are shorter than the duration of their liabilities, which is gold dust when it comes to NBFCs, because majority of the NBFCs operate exactly opposite. They tend to borrow short and lend long and make the spread, which is easy, which doesn't require any sort of competitive advantage. When the cycle turns, you pay the yield curve sort of flips, and you're stuck in that asset liability mismatch, which means that even at times of best scope for credit growth, you don't have access to funding, which can help you take advantage of that. Worse, your liquidity risk starts playing into a solvency risk. So the key for us is, even for an NBFC, if we can find that positive asset liability profile, it almost behaves like a bank.
Would the new normal of valuation for NBFCs be lower? I heard you mention that the new normal for high quality banks, the average valuation multiple could be higher because they'll come out with lesser competition. Would the same hold true for the NBFC space also? Because, one of the premier NBFCs just traded at such high valuations that thinking of a higher multiple in a lesser competitive scenario eventually seems a bit outlandish to me right now. But I may be wrong, of course.
Yeah, but look, again, we don't know. We don't know whether 8 times price to book or 9 times price to book is what is going to be the new normal, or higher than that. What we know is back then as well, when it was trading at that sort of price to book, we saw long-term value, right? Now, going by the same logic I gave you a few minutes ago, we will see a similar consolidation in the NBFC space as well. If you believe that the opportunity for NBFCs hasn't changed, but there are fewer competitors vying for that opportunity, you can justify a case for a higher valuation, all things being equal. Now, it's a different matter if you think that suddenly banks will start taking market share from NBFCs for various reasons and so on. But all things being equal, if you believe in the consolidation theory, you can argue for a higher multiple. And now, that's assuming that you were okay with the multiple that the NBFC was trading at pre-crisis. And
Are you?
We were, of course. So we kept buying even at 5,000 rupees for Bajaj Finance. I think the long run opportunity is intact, and like I said, if at all, it's only improved with fewer and fewer NBFCs operating in that space, and therefore. We believe that the difference between the intrinsic value and the stock price is only expanded.
Right. That's a very candid promote. Now, I want to move the conversation to a slightly different plane in the last few minutes, and the distinction between lending financials and non-lending financials. Do you guys have exposure to non-lending financials? What is your view there? Because there the valuations haven't corrected as much as some of the lending financials.
Yeah, we do. In some of our portfolios, we do hold a general insurance company. We are quite excited about consolidation generally in financial services. I think across the board, whether it's insurance, whether it's asset management, whether it's broking or wealth management, we believe consolidation is here to stay. The stronger companies will become stronger and stronger and take market share away from the weaker ones. So we are very closely looking at a lot of the non-lending financial plays. Like I said, we already own a general insurer in some of our portfolios, but yeah, I mean, I wouldn't be surprised if we add more non-lending financials to our portfolios over the coming months, given the consolidation trend that we are seeing.
Are you more bullish on the lending financials? If it's possible to make a distinction, because for example, a guest that I spoke to 3 days back said that even though financials are a bit of a problem, he's still bullish on the lending financials and doesn't want to take too much of exposure to non-lending financials, because in insurance, promoters are selling. In asset management companies, the rate of growth will be much slower considering what's happening to equities, etc. And therefore, he'd rather prefer the high quality lending financials. Are you making some distinction? Do you have a preference for lending versus non-lending?
I would tend to agree. I think the lending financials offer a significantly better opportunity. It will always remain a bigger part of our portfolio in terms of allocations compared to the non-lenders. The consolidation wave will also be far more amplified in lending financials compared to non-lenders. The ability to build competitive advantage and sustainable competitive advantage is also much better amongst lenders, because the very fact that it's a very cyclical place dependent on leveraged balance sheets means that you will see very high troughs and crests, and which will also result in significant mortalities with every cycle, and that leads to more and more waves of consolidation. Whereas in the loan lending space, I think there are a few really good franchises which will sustain for a long period of time, and hence the growth rates for these companies will be by and large commensurate to the industry growth rate. There will be some benefits of consolidation, but it won't be as disproportionate as we've seen in the lending space.
Last question, Pramod. I didn't hear you mention life insurance when you spoke about non-lending.
Yes, I mean, we're closely looking at that space. At this stage, we don't have any exposure, but like I said, across life insurers, asset managers, brokers, and wealth managers, we will likely to have a few names come up in the next few months.
No, I mean, sorry, I was not trying to second guess what you would do. I was just wondering if you are negative on life insurers compared to general insurers. I'm glad I got that clarity. Okay, Pramod, anything that I haven't asked you that you want to bring about when it comes to financials?
No, I think financials are lifeblood of the economy, and to that extent, they will always remain center stage. They'll always remain the best money-making opportunities in the marketplace, provided you can find the ones which have built sustainable competitive advantages, and more importantly, especially when there's balance sheet involved, a significant degree of prudence rather than any sort of aggressive bravado in terms of delivering growth will always keep investors in good stead.
Great. Pramod, it was a pleasure talking to you today. Thank you so much for taking the time out and speaking to us. We could have spoken about a lot more, but I think it's such a large topic that the time got completely evolved there. But thanks so much for taking the time out.
Thanks, Dheeraj. Pleasure.
And viewers, thanks for tuning into this broadcast.